Okay, let's unpack this. We've received what feels like an unearthed financial artifact, really. It's a blueprint for prosperity, titled simply, Periods When to Make Money.
Right. And it's not just, some dusty historical document. It's a specific predictive chart. It claims to detail economic cycles from the roaring 1920s all the way out to the year 2059. That's quite a span.
A huge span. And what's fascinating here, isn't it, is that this source tries to turn the sheer kind of dizzying chaos of market fluctuations, all that human irrationality.
Into a predictable, repeating rhythm.
Exactly.
It operates on this core assumption that history repeats itself with uncanny, almost mathematical precision, which, is an idea with deep roots.
Definitely. This approach viewing market activity less like linear growth and more like, I don't know, astronomy with fixed orbits and recurring dates.
Yeah, that's a good way to put it. It was certainly a feature in some financial theories back in the early 20th century. And this document, instead of just giving generalized advice, it lays out this purported roadmap, a timeline of highs and lows year by year for over 130 years. It's even giving explicit instructions for the next, half century from when it was likely made.
Incredible ambition. So our mission in this deep dive is pretty straightforward. We're going to extract the specific patterns, the absolute dates, and the hard-nosed investment advice contained within this single cyclical view of wealth creation.
It's like we're reverse engineering this specific prediction engine.
Exactly. Think of it as your shortcut to understanding the internal structure here. We need to go beyond just a summary and really dig into the implications of these fixed chronological instructions.
Okay, so to organize this, maybe we could break it down into three core concepts. They sort of interlock like gears driving this whole machine.
Good idea. What are they?
Well, first there's cycle A. That defines the macro shocks, the specific, strategically crucial panic years. That's the big picture rhythm.
Okay, panic years. Got it.
Then there's cycle B. This gives us the granular year-by-year markers for good times and high prices. It's almost like an implied numerical prosperity index.
Yeah.
Dictating maybe not daily, but yearly behavior.
A score for the market's mood year by year. Interesting.
And finally, cycle C. This is the explicit, non-negotiable strategic advice. How to buy, what to buy, when to sell, based directly on where you are in those first two cycles.
So if you buy into the premise of this chart,
Right, if you buy in, the goal isn't just to survive the market swings, it's to monetize them perfectly year after year following this script.
okay, let's start with the foundation then. Section 1, the predictable rhythm of panic, or cycle A. This feels like where the source really establishes this authority, doesn't it?
It does. The chart literally begins by listing years in which panics have occurred and will occur again. So right away, it's laying down this macro cycle foundation for the whole theory, defining when the system supposedly resets and prices hit rock bottom.
So what dates does it give us historically?
Okay, looking at the historical data points cited, it seems the author was meticulously trying to prove a recurring pattern, even if it's slightly flexible. The chart identifies 1927 as a foundational panic year.
1927, okay, before the big crash.
Right, and following that, 1945 is cited as the next major shock.
1945, hold on.
Yeah, 1945. That establishes the first observed cycle length in their model, coming in at a clear 18 years.
But wait, 1945, that was the end of World War II. For the U.S. economy, at least, wasn't that a period of massive transition and eventually huge expansion? Calling it a panic year feels counterintuitive.
That is an extremely important question. And you're right, it does feel counterintuitive by today's definitions. It suggests the author's definition of panic might not strictly align with, say, GDP contraction or a devastating bear market like '29.
So what could it mean then in this context?
Well, in the context of this kind of cyclical theory, panic often seems to mean a major inflection point, a significant financial and maybe emotional disruption that forces a kind of market reset, regardless of the broader geopolitical context.
Ah, okay. So maybe it refers to specific assets the author tracked, like commodities or real estate hitting a bottom.
That's very possible. Or maybe just a point of maximum uncertainty that felt like a panic to investors at the time, forcing a repricing. For the purpose of this roadmap, 1945 acts as that crucial turning point, the deep valley before the next long climb, according to this chart.
Got it. Okay. So after 1945, the rhythm starts to vary slightly, which is kind of interesting in a chart that claims predictability. What's next?
The next date listed is 1965. That establishes a 20-year cycle length from 45 to 65.
So the rhythm is already flexing. It went from 18 years to 20 years.
Exactly. The author seems to acknowledge, implicitly at least, that external forces might stretch or compress the timeline. But the general concept, this idea of a recurring shock every, say, 16 to 20 years, that holds firm in their view.
Okay, so after 65.
Then we see the cycle tighten back up significantly. The next date cited is 1981, which is only 16 years later.
Wow, 16 years. That's the shortest gap cited so far. Suggests a highly compressed or accelerated cycle between 65 and 81.
It does. And then 1999 follows 1981.
Which is 18 years again.
Exactly. It returns precisely to that original 18-year cycle length. So this variability itself, 18, 20, 16, 18 years, becomes a key structural element. It tells the investor, okay, you can't just rely on adding exactly 18 years every time.
You have to anticipate that the market's internal forces, or whatever drives this, can stretch or compress the timeline by maybe 2 years either side of that 18-year average.
Right. And the author, in a way, is claiming to have sort of solved for that unpredictable variable. The power of this source, or its claim to power, isn't just its historical record, but that it immediately extends this observed pattern forward. It forecasts future major disruptions based on this established variable rhythm.
So let's look at that forecast. Following the last historical observation in 1999, where does it point next?
The chart predicts the next panic year would be 2019.
2019. Okay, how many years is that from 99?
That's 20 years, a 20-year gap from 1999, which interestingly mirrors the 20-year jump seen between 1945 and 1965.
Ah, so the author is actually using the sequence of variability itself as part of the predictive pattern. It's not random variation to them.
It seems like it's almost like a fractal approach to time, And looking further out, the roadmap continues this pattern. It asserts the next panic will come in 2035.
Okay, 2035. And the gap there from 2019.
That would be 16 years, which is designed presumably to mirror the compressed 16-year gap observed between 1965 and 1981. It seems to be following a strict rotation of these cycle lengths, 18, 20, 16, 18, 20, 16.
And then the last panic year marked on this document.
That's 2053, which completes the predicted sequence with an 18-year gap from 2035.
Returning to the original 18-year length observed between 1927 and 1945. Wow, okay.
So if we connect this back to the bigger picture, these panic years, they're the anchor points. They establish the outer bounds of the entire economic cycle as envisioned here. They represent the point of maximum fear, maximum pessimism.
Which means they define the periods where prices bottom out, making them the ultimate strategic buying opportunities according to this system.
Precisely. Every other action the chart advises hinges on successfully identifying and timing these panic dates. They lead directly into the longer periods the chart defines as good times. The whole system hinges on knowing when the market's at its absolute emotional and financial low point.
Which this chart claims to have timed down to the specific year, decades in advance. That sets the stage beautifully. So, if Cycle A tells us when to panic, and crucially when to buy at the bottom, Cycle B must be about navigating the years between those panics. So let's transition into Section 2. This is where, as you said, it gets really interesting.
Yeah, I think so.
We move from the macro shocks of Cycle A to the granular year-by-year predictions of Cycle B. And Cycle B outlines, quote, years of good times, high prices, and the time to sell stocks and values of all kinds.
Right. This section is really the engine room of the whole document. It provides these very specific data points suggesting this implied index or metric of prosperity, or maybe speculation, that the user is meant to follow year by year.
It's like an instruction manual disguised as a fluctuating score chart.
That's a good way to put it.
So let's look at the structure first. How is it laid out?
The chart is divided into columns, and these columns seem to be based on major peak years. The specific years the author flags as prime selling opportunities.
Okay, what are those peak years listed?
They list 1926, 1935, 1945.
Wait, 1945 again? That was a panic year in Cycle A.
Exactly, good catch. 1945 is listed as both a panic year in Cycle A and a good time peak year in Cycle B. We need to talk about that.
Definitely. Okay, keep going with the peak years.
Right, so 1926, 1935, 1945, 1953, 1972, 1972, 1980, 1989, 1999.
1999 again, too. Another panic year.
Yep. Then 2007, 2016, and then projecting into the future. 2026, 2034, 2043, 2053.
2053, another panic year overlap.
And the final peak listed is 2059.
Okay, so these peak years are often offset from the panic years, but sometimes they land on the exact same year. What does that suggest?
Well, the 1945 and 1999 examples where panic and peak align. It might suggest a very rapid V-shaped recovery where the bottom and the subsequent peak happen very close together. Or, maybe more likely in this model's logic, the author views the absolute peak price and the financial inflection point, the panic, as occurring almost simultaneously.
Like the final blow-off top happens right as the underlying structure breaks.
Something like that. It also highlights the variable spacing between peaks. Look at the gaps. 1926 to 1935 is 9 years. 1945 to 1953 is 8 years. 1980 to 1989 is 9 years. Again, it reinforces that this system isn't just tracking one simple index. It's trying to capture something more complex, maybe a blend of economic confidence, speculative fever, and actual asset prices.
Okay, but the really unique thing here is the numerical metric, right? This chart assigns numbers, values from 1 through 11 to nearly every single year on the timeline.
Yes, that's the core mechanism for Cycle B.
And these numbers track the supposed level of good times. It's basically giving a real-time score of the market's temperature, according to the specific artifact. We need to be really clear about what these numbers are supposed to mean.
Absolutely. Think of this scale maybe as charting emotional excess in the market. The highest values 8, 9, 10, and especially 11 are explicitly associated with the timing for selling. Quote, selling stocks and values of all kinds.
So if you see a high number, especially 10 or 11 for a given year on this chart,
The instruction is crystal clear. Unload your assets. An 11 isn't just a high score. It seems to represent the market absolutely boiling over. Maximum emotional excess, peak speculative fever. Get out before the music stops.
and it's worth noting how often certain numbers appear at peaks.
Definitely. The number 10 seems to be the most frequent high water mark. It appears prominently in those peak years like 1926, 1945, 1972, 1999, and it's projected again for 2026.
Okay, so conversely, the lower value years must be the buying signals, right? Those scoring 2, 3, 4, or 5.
Exactly. Those are absolutely crucial for the buyer following this system. They presumably represent the deep value periods, the years immediately following the major panic events from Cycle A, or perhaps significant mid-cycle corrections. These low numbers are the windows where the investor, based on the advice in Cycle C, is meant to be accumulating assets.
Buying when the score is low, selling when it's high. Sounds simple, but the yearly numbers add a lot of granularity.
It's far from a simple buy and hold forever strategy. To really appreciate the detail and how the author likely intended it to be used, we probably need to trace a few complete cycles, see how the score fluctuates.
Good idea. Let's trace the full 18-year span between the 1927 panic and the 1945 panic peak based on the source material. What do the numbers show?
Okay, so following the 1927 panic, the economy obviously enters the Great Depression, but the chart doesn't show like a flat line at the bottom for years. It actually shows an immediate small bounce in 1928, scoring a 4.
Oh, 4, okay.
Then a deeper low of 2 in 1929. That likely coincides with the actual crash and the immediate aftermath. That score of 2, that's the real buying signal, according to this logic.
Sets up the next phase.
Right. Then the metric begins its slow, maybe painful climb. We see scores of 3, 4, 5, and 6 through the early 1930s. It shows a gradual recovery. Until the first designated mid-cycle boom year of 1935, which scores a 9.
A 9. So the investor who followed the chart would have bought perhaps near that low score of 2 in 1929 or 3 in 1930.
And potentially sold a significant portion when the score hit 9 in 1935, capturing that recovery wave and maybe avoiding a subsequent dip.
What happens after that 1935 peak score of 9?
The score drops back down. It shows a 6 in 1936, then kind of stabilizes around 7 and 8 through the late 1930s, heading towards World War II, and then comes the final run-up to the 1945 event.
And the score in 1945 itself.
The chart shows the score hitting 10 right there in 1945, which, again, is fascinating because it's marked as both a major panic year and a peak selling year with a score of 10.
That really demands we consider the mechanism. Why would peak price and panic collide in this model? It feels paradoxical.
It's either the counterintuitive genius or maybe a fundamental flaw of the system, depending on your view. It suggests that perhaps the final, most aggressive phase of a speculative bubble often bursts very late. People might rush to buy right up until the moment the inflection point is hit.
Maximizing the price just before the systemic panic fully sets in. The highest point of euphoria crashes headlong into the moment of ultimate structural stress.
That seems to be the implication. This detailed sequencing shows the chart is far more complex than just a simple wave up and down. It's almost fractal, you know? Intense peaks and valleys within the broader 16 to 20-year macro cycle.
Okay, let's look at a cycle maybe more familiar to some of us. How about the 18-year span between the 1981 panic and the 1999 panic peak? What do the numbers show there?
Right, good one. The cycle begins after the 1981 panic. Interestingly, not with a super low score, but with a respectable 8.
An 8 right after a panic?
Yeah, and it's immediately followed by a jump to 10 in 1982.
Wow, so not a slow climb at all that time. It's an immediate, aggressive rebound according to the chart.
Seems so. The implication is if you bought during the low following the 81 panic, you might have only had about a year to capitalize before the market, by this metric, shot up to a major selling signal, score of 10.
What happens after 82? Does it stay that high?
No. Then we see some moderation. A 9 in 1983, then back to 8 in 1984, before spiking back up to 9 in 1985. The system looks highly volatile, even within the so-called good times.
It suggests you need pretty quick trading action rather than just passive holding to really follow it.
That seems right. It maintains some momentum with a 7 in 1986, but then, bam, it hits an extremely high peak of 11 in 1987.
11. The highest possible score on this chart.
Yes. And we know what happened in October 1987 in the real world. This chart marks 87 with an 11, the ultimate signal of maximum greed, the absolute time to liquidate according to its rules.
And then it corrects
Sharply, back to a 7 in 1988. This suggests that even within a long boom period, there are these extremely aggressive microcycles that need careful navigation if you're following this.
That rapid fluctuation continues, doesn't it? What about the late 80s, early 90s?
It does. 1989 shows a 9, followed by an 8 in 1990. Then, crucially, the metric drops quite sharply. It hits 6 in 1991 and bottoms out at 5 in 1992.
A 5. Okay, that's nearly halfway through the cycle, from 81 to 99. And while 5 isn't one of the primary buying signals like 2 or 3,
it's still a very important detail. A score of 5 represents a significant mid-cycle drawdown. It's essential for the follower of this chart to recognize that.
it's like a secondary buying opportunity.
Exactly. It appears to be a secondary buying opportunity, even though it isn't a primary cycle, a panic year. The investor who maybe sold near that 11 score in 1987 would potentially wait for this dip to 5 in 1992 to repurchase assets. This complexity really elevates the chart from just a macro forecast to more of a genuine tactical guide.
Absolutely. So following that mid-cycle dip in 92, what does the score do leading up to the 1999 event?
It begins its final massive run-up. It rises through 7 in 1993, then hits another extreme peak of 11 in 1994.
Another 11, the second instance of maximum greed within the same cycle.
Right. Then it moderates slightly again with a 7 in 1995 before hitting another 10 in 1996. The market, according to this chart, is constantly hitting these peaks and then retreating slightly, requiring vigilance.
And the final years, 97, 98, 99.
The final years leading into the 1999 panic peak show a slight easing, a 9 in 1997, an 8 in 1998, and then echoing that 1945 pattern we saw, it returns to 10 right in 1999 itself, the predicted panic year.
So that pattern seems consistent. Aggressive volatility, mid-cycle dips offering buying chances, and peak scores often coinciding with the major Panis inflection points. That feels like the defining feature of this whole methodology.
I think that captures it well.
Okay, now let's try to make this actionable for the listener today. What are the future projections provided by this chart? Let's zero in on the values projected around the current period, say 2024 through the projected 2035 panic.
Okay. According to the source material we have, the score for 2024 is projected at a 7.
A 7. So moderately high, not a buying signal certainly, but maybe not an extreme selling signal like a 10 or 11 either.
That seems right. But it doesn't stay there long. It apparently accelerates quickly. The chart predicts a major spike to 10 in 2026.
2026 gets a 10, and is that marked as a good time peak year?
Yes. 2026 is specifically designated as one of those good times, high prices, peak years. So that's the nearest most critical peak the chart is advising its followers to prepare for. Sell in 2026 when the score hits 10.
And after that projected 2026 peak, what does it show?
It shows a predictable cooling period following the pattern, a drop back to 9 in 2027, then 8 in 2028. And it continues to drop through the late 2020s and early 2030s, hitting values like 6 and significantly 5 again.
Another 5. So the chart predicts another mid-cycle drawdown, potentially another secondary purchasing opportunity sometime before the 2035 panic really sets in.
That's what it suggests. A dip, maybe around the 2030 to 2032 timeframe, before the cycle finishes its course and hits the projected 2035 panic year.
And the score for 2035 itself, the panic year.
It's projected to score a 9 right as the panic hits. Again, that high score coinciding with the panic event.
And beyond that, does it go further?
It projects continued volatility after 2035, eventually culminating in one last major boom marked in 2059, scoring a 9. And that's the final data point provided on the entire timeline we have access to.
This incredibly detailed, fluctuating metric, it raises a really important question. What kind of investment behavior does this imply? It's not just buy and hold.
Not at all. It seems to demand almost constant vigilance. It provides this year-by-year score of the market's temperature, guiding the user to take specific actions buy or sell based purely on that assigned numerical value for that specific year. It's really an instruction manual for hypervigilant, date-specific trading or market timing.
Overwriting everything else. News, earnings, gut feelings.
Precisely. The fact that the author went to the immense trouble of assigning over 130 years of these numerical scores strongly suggests they intended this to be the primary, perhaps only, decision-making tool. You follow the NAR for the year, period.
Okay, that brings us perfectly to Section 3, the hard-nosed investment strategy, or advice C. If cycles A and B are when the panics hit and how high the market gets in between, cycle C is the what you actually do.
Exactly. This is where the rubber meets the road. The final piece of the source is this explicit advice, translating all those complex cycles and numbers into concrete, seemingly non-negotiable instructions for making money.
And it boils the strategy down to two key phases, doesn't it? Contrasting hard times with good times.
Yes. The first, and arguably most crucial instruction, covers the strategy for hard times, low prices. This is when you're supposed to act decisively. And the advice is very specific about which assets the investor should be targeting.
Right. The prime time to buy is explicitly stated. The period immediately following those panic years identified in Cycle A, when prices are low, when the score in Cycle B is bottoming out maybe around 2 or 3.
And the instruction is to acquire 3 specific types of assets then. What are they?
Stocks, corner lots, and goods.
Okay, stocks make sense, but corner lots, that's fascinating. Yeah.
It really anchors this philosophy in the early 20th century, doesn't it? It's not just general real estate advice. It's specifically about commercial land speculation. That piece of land at the junction of 2 roads expected to become commercially valuable as the town or city expands.
Yeah, for the original author, that asset class must have been a cornerstone of cyclical wealth generation. It demands real foresight, looking years, maybe even decades, into the future based on where the cycle is.
And goods is equally intriguing. It's so broad. What do you think that meant back then?
It likely encompassed commodities, raw materials, maybe industrial inputs, anything essential that could be bought cheap, perhaps held, and then sold later at a much higher price when the good times rolled around.
So not consumer electronics, but maybe oil, rubber, grain, cotton, or perhaps even industrial machinery itself. Things needed to fuel the upcoming boom.
That seems plausible.
Yeah.
Buying the physical inputs for the next cycle of expansion. The emphasis here, regardless of the specific asset stocks, corner lots, or goods, is on capitalizing during those low periods following fear and panic.
You absolutely must be willing to buy tangible, depressed assets when that numerical metric is screaming 2, 3, or maybe 4, when everyone else is presumably terrified.
And then, once the investor has made these strategic purchases during the hard times, the strategy shifts entirely. It becomes about patience. The mandate for the good times is very clear.
What is it?
Quote, hold till the boom reaches the years of good times, then unload.
Hold until the boom peaks. So this requires a really unique kind of discipline, doesn't it?
Absolutely. You have to buy when everyone is panicking and the price is low, guided by Cycle A and those low numbers in Cycle B. And then you have to wait, potentially for years, until the market hits maximum speculative frenzy guided by those high numbers, 10 or 11, in Cycle B.
It forces the investor to act completely contrary to mass emotion. Twice. First, buying into fear, and second, selling into euphoria.
That's the essence of it. And the beauty, or maybe the sheer audacity of this strategy, is its surface simplicity, but its strict, almost brutal adherence to the charted dates.
Right. The investor is explicitly discouraged from trying to time minor fluctuations based on daily news noise or reacting to external events. You're just meant to align your action with the chronological prediction of this chart. Treat it as gospel.
And the original author's confidence in this system, it's immense. It's really reinforced by the language used right on the document. The core instruction, the whole philosophy, is presented as non-negotiable. Right underneath the detailed advice, the chart just states, sure thing.
Sure thing. That is a wildly confident, maybe even arrogant claim, especially given the significant variability in cycle length we already observed 16, 20, 18 years. To claim sure thing suggests the author believed this wasn't just a strong hypothesis,
but practically a fundamental law of economic nature. It's the ultimate psychological hook, isn't it? It guarantees success if you just follow the dates perfectly. It leverages that deep human desire for certainty in a world that feels inherently uncertain.
And that certainty is reinforced by the final command at the bottom of the source, right?
Yes. Save this card and watch it closely. It underscores that this information isn't meant to be merely academic or historical curiosity. It's intended as a living, actionable roadmap, something that dictates exactly when you put your capital to work and exactly when you cash out, effectively removing human judgment, fear, and greed entirely from the equation. Just follow the card.
So bringing all three cycles, A, B, and C together, what we have is a complete self-contained financial philosophy.
That's right. Economic events, according to this artifact, follow a defined, predictable rhythm. They're punctuated by these panics every 16 to 20 years.
And savvy investors simply need to align their buying of stocks, corner lots, goods with the low points following those panics.
And align their selling with the specific years that hit the numerical prosperity metric high points, usually 10 or 11.
It promises structure and chaos, and that structure is based entirely, almost mystically, on the calendar.
So just to summarize what we've really mapped out today, we've successfully decoded the key dates and instructions of this pretty fascinating cyclical chart of wealth. We identified the panic cycle, cycle A, which defined those major financial disruptions from 1927 all the way up to the projected date of 2053.
Right, showing that repeating rhythm of 16 to 20 years that the author uses as the basis for the entire prediction model.
Then we did a deep dive into cycle B, the periods of good times. We charted that prosperity index from 1926 onward, analyzing the specific yearly numerical metric 1 through 11.
And we saw that the advice for selling is explicitly tied to those years scoring 10 or 11. We noted those critical mid-cycle drawdowns like 1992's score of 5 that offer potential secondary buying chances. And that strange phenomenon of peak pricing, like in 1945 and 1999, coinciding with the predicted panic year itself.
And finally, we detailed the essential strategy, cycle C. The explicit instruction to buy those specific, maybe historically relevant assets, stocks, corner lots, and goods during the low-price hard times.
And crucially, to hold that investment until the boom years arrive, guided strictly by the charted dates, all underwritten by that incredible guarantee of sure thing.
The enduring power of an artifact like this, isn't just in its detail, is it? It's in its reliance on that deeply compelling idea that history repeats itself perfectly.
Yeah, it offers this structured, chronological path through what feels like overwhelming economic complexity. It sort of sidesteps the need for constant fundamental analysis or reacting to the daily news cycle.
This core concept, that the future is simply a predetermined variation of the past, well, it takes the guesswork out of the investor's job, doesn't it? It seems to replace intuition or complex analysis with just adherence to a calendar. It's a powerful example of a highly disciplined, maybe rigidly date-driven approach to trying to build wealth.
Which leads us to our final provocative question for you, the listener. Based solely on the source material we've unpacked today, if you were to actually save this card and watch it closely as instructed, how would you interpret the current numerical metric on the chart to determine your exact investment strategy right now?
Yeah, that's the real test.
Specifically, given the projected score of 7 for the current year, 2024, and that impending predicted spike to 10 in 2026. Which of the specific assets mentioned, stocks, corner lots, or goods, would you prioritize buying or perhaps holding right now, and why?
Would you be positioning to sell everything into that potential 2026 peak? Or, knowing the pattern, would you maybe try to hold some powder dry, waiting for that predicted mid-cycle dip? The chart seems to show somewhere around 2030 to 2032 for the next big panic in 2035. How would you play it using only this map?